We're going to now look at the preparation of the investing activities section and financing activities section of the statement of cash flows. Now, the second step in preparing the statement of cash flows is to determine the net cash flows from investing activities by analyzing changes in long-term asset accounts from the balance sheet. So we would look at the increase or the decrease in assets such as property, plant, equipment, and tangible assets. Now, looking at the long-term asset section of the eGames balance sheet, we look at the following cash flows from investing activities. So as far as increase in investments go, investments increased $35,000 during the year from zero to it was in 2017 to $35,000 in 2018. In the absence of any evidence, it's logical to assume this increase is due to purchasing investments during the year. But we saw in a previous slide that it confirmed this assumption because it showed that there was an investment purchased. So we report the purchase of investments as a cash outflow of $35,000 from investing activities. Now, next we're going to have the decrease in land. The land account decreased $10,000 during the year, indicating that eGames sold land costing $10,000. Well, additional information we saw earlier on a previous slide showed that we originally recorded the land at a cost of $10,000, but we sold it only for $6,000, which resulted in a loss on the sale of land of $4,000 as recorded in the operating activity section. But we report the $6,000 that we received in cash as a cash inflow from investing activities, and that's the actual amount of cash proceeds that we received from the sale, and we see it here on this slide. Now, we also are going to talk about an increase in equipment. Now, eGames equipment account increased by $20,000 during the year. So if eGames purchased the equipment with cash, we would record it as a cash outflow. But the additional information showed that the firm paid for the equipment by issuing a $20,000 note payable. So there's not any cash exchange in this transaction. So the increase in equipment represents a non-cash activity, which is disclosed either directly after the cash flow statement or in notes to the financial statements. This slide provides the summary of the cash flows from investing activities and the disclosure of that non-cash activity. Now, the third step in preparing the statement of cash flows is to determine the net cash flows from financing activities. So, to fund its operating and investing activities, companies must rely on some type of external financing from two sources, either from creditors or shareholders. So, cash transactions, which are inflows and outflows with creditors and shareholders, get reported in the financing activities section of the statement of cash flows. We can find a firm's financing activities by looking at changes in long-term liabilities and stockholders' equity accounts from the balance sheet. Now, looking back at the eGames balance sheet, we can find the following cash flows from financing activities. There was an increase in notes payable. eGames has only one long-term liability. The company reports an increase in notes payable of $20,000 As we saw earlier, this was in payment for equipment and represents a non-cash activity that was disclosed in the notes to the financial statements. There's also an increase in common stock. Common stock increased by $5,000 during the year. In the slide that showed some additional information, it confirmed that this was a result of issuing $5,000 of common stock. So this slide shows the $5,000 inflow of cash reported as a financing activity. Now, there's also increase in retained earnings. The eGames retained earnings balance increased by $30,000 during the year. Now, recall that the balance of retained earnings increases with net income and it decreases with dividends. Now, since net income was $42,000 and retained earnings increased by only $30,000, the company had to have declared dividends of $12,000 during the year. So item 5, listed as additional information on one of those previous slides, confirm that eGames declared and paid dividends of $12,000 during the year. So this slide shows that we report the payment of cash dividends as a cash outflow in the financing activity section. It's important to note here, most investing activities are explained by changes in long-term asset accounts, and most financing activities are explained by changes in either long-term liabilities and the stockholders' equity section. Let's look at a question. Which of the following would be included in the investing activities section of a statement of cash flows? Would it be A, sale of a piece of equipment, B, payment of dividends, C, increase in the balance of accounts payable, or D, depreciation expense? Now I want you to realize, remember, accounts payable and depreciation would involve operating activities only. The payment of dividends would be financing activities. The sale of a piece of equipment would be in the investing activities. Note that the gain on the sale of equipment or the loss on the sale of equipment would go into the operating section, but the actual sale of the equipment would be in the investment activity section. Here's another question for you. Which of the following would be included in the financing activity section of a statement of cash flows? Sale of a piece of equipment, payment of dividends, increase in the balance of accounts payable, or amortization expense? Well, again, financing activities would include the purchase and sale of stocks for the company, loans, and the payment of dividends. Any amortization, accounts payable would always be operating. Now, the fourth and final step in preparing the statement of cash flows is to combine the operating and the investing and the financing activities and make sure the total of these three activities equals the net increase or the net decrease in cash in the balance sheet. Now remember, we take the cash at the beginning of the period, the cash at the end of the period, and that will show us an either increase or decrease in cash. In this example, it's a $14,000 increase. So all of our adjustments and our cash flows from all three activities need to equal that $14,000. So this is the moment of truth. The sum of the net cash flows from all three, operating, investing, and financing activities, need to equal that net increase or decrease in cash for the period. Now, in the illustration, we see that the total of the cash flows from operating are plus $50,000, investing are a minus $29,000, and financing are a minus $7,000. Those activities equal the net increase in cash of $14,000, reconciling the cash from the two consecutive balance sheets that were originally reported earlier in the slide. Let's look at how we perform financial analysis using the cash flow statement. Now, analysts often supplement their investigation of income statement and balance sheet amounts with cash flow ratios. Some cash flow ratios are derived by substituting net cash flows from operating activities in place of net income, but not to replace those ratios, but to complement them. Now, substituting cash flows from operations in place of net income helps offer some additional insight in the evaluation of a company's profitability and of its financial strength. Positive cash flow from operations is important to a company's survival in the long run. Again, if they want to pay their bills, they need cash. Let's re-examine the financial ratios that were introduced in a previous lecture. Let's talk about return on assets, profit margin, and asset turnover. Substituting net cash flow from operating activities, which we can also call operating cash flows, in place of net income. Now, this slide provides financial data for Apple and for Google. Now, return on assets, as we talked about previously, is calculated as net income divided by average total assets. This slide presents return on assets for Apple and for Google. Now, the ROA for Apple's really high at 18%, and Google reports a pretty respectable return of assets at 11.9%. Now, we can gain some additional insights by looking at a similar measure called the cash return on assets. We calculate it by operating cash flows divided by average total assets. So, this slide presents the cash return on assets for Apple and for Google. Now, Apple's return on assets of 27.2% is a heck of a lot higher than Google's cash return on assets of 18.5%. Operating cash flows exceed net income for both Apple and Google. Let's talk about the cash return on assets further by separating the ratio into two separate parts as shown on this slide. So cash return on assets can be separated into cash flow to sales and asset turnover. Now, cash flow to sales measures the operating cash flows generated for each dollar of sales. It's the cash flow equivalent to a profit margin. Asset turnover, also talked about previously, measures the sales revenue generated per dollar of assets. Now, cash flow to sales and asset turnover represent two primary strategies that companies have for increasing their cash return on assets. Now, one strategy pursued by both of these companies, Apple and Google, is to sell highly innovative products that yield really high cash inflows from customers in relationship to the cash outflows that produce their products. Now, another strategy is to produce high asset turnover by selling at lower prices than the competition. Now, in this slide, we calculate cash flows to sales and asset turnovers for both companies. Now, the cash flow to sales ratio support our expectations regarding the business strategies of Apple and Google. Both of the companies report high cash flows to sale ratios of 32.7 for Apple and 33.9% for Google. Both companies also report asset turnover below 1, which indicates a high margin rather than a high turnover strategy. However, Apple generates a slightly higher asset turnover than Google. Helps to explain why Apple's overall cash return on assets is higher than Google. Now, to maximize cash flow from operations, a company wants to increase both cash flow per dollar of sales and sales per dollar of assets invested. So they want to increase both the cash flow to sales and the asset turnover. Let's look at an exercise. 11-12. Zoogle has the following data. We show the net income, the operating cash flows, the beginning assets, and the ending assets. So our job is to calculate the return on assets, to calculate the cash return on assets, and calculate the cash flow to sales ratio and the asset turnover ratio of Zoogle. So the return on assets is going to be the net income divided by the average total assets. So again, we're going to take the net income of $66.20. We're going to divide it by average assets, which means the beginning assets plus the ending assets divided by 2. So our return on assets here is 14.3%. Now, to calculate the cash return on assets, we take the operating cash flows of $93.26 and we divide those by the average assets to give us 20.2%. Then, to calculate the cash flow to sales ratio and the asset turnover ratio, we're going to take the operating cash flows, dividing that by net sales. So the $93.26 divided by our net sales of $24,651 gives us cash flows to sales of 37.8%. Then, taking the asset turnover ratio, we're going to take our net sales, divide that by our average total assets, which gives us our asset turnover of 0.5 times. Let's check your understanding with another question here. Which of the following ratios is computed by dividing operating cash flows by net sales? Do you have any ideas there? The cash flows to sales ratio is calculated by dividing the operating cash flows by net sales. Next, we're going to prepare the operating activity section of the statement of cash flows using another method called the direct method. Now, there are two acceptable alternatives in reporting operating activities. We can go the indirect method and the direct method. Now, the presentation of operating activities in the main body of the chapter is referred to as the indirect method. By this method, we begin by reported net income and we work backward to convert to a cash basis. But this is an alternative method called the direct method, where we report the cash inflows and the cash outflows directly on the statement of cash flows. So, for example, we report cash received from customers as the cash effect of sales, and cash paid to suppliers as the cash effect of cost of goods sold. Income statement items that have no cash effect, like depreciation or gains and losses on the sale of assets, are simply not reported under the direct method. Now, using the direct method, we examine each account in the income statement and we convert it from we're going to convert it from what is normally an accrual method to a cash amount. So the best way to apply the direct method is to convert each revenue and expense item to its cash basis amount. So we do this by considering how each income statement account is affected by related changes in current asset and current liability accounts. Let's look at an example. So we're going to take the operating activity, or we're going to prepare the operating activity section of the statement of cash flows for Peach Computer, and we're going to do it using the direct method. So what we're going to do here is, as you see, we're going to take the net sales and we're going to add the decrease in accounts receivable to show us the cash that was received from customers. Because remember, if there was an increase in accounts receivable, then that means our net sales, we had less cash from those sales. But if we have a decrease in accounts receivable, then that means that we had a lot more people paying cash, so we get to add that decrease in accounts receivable. Now with our cost of goods sold, we're going to look at an increase of inventory. We'll add that to our cost of goods sold to come up with our purchases. Now if we have an increase in accounts payable, we're going to subtract that, because an increase in accounts payable means we used less cash. That cost of goods sold plus an increase in inventory minus an increase in accounts payable is going to equal cash paid to suppliers. Now, that's this example, but if we had cost of goods sold minus a decrease in inventory, we would subtract a decrease in inventory. That's going to equal our purchases. Our operating expenses of $660, we're going to subtract the decrease in prepaid rent, because as our prepaid rent goes down, that means that we have used up that rent expense without having cash. Our cash paid for operating expenses would be our operating expenses minus that decrease in prepaid rent. Then we've got our income tax expense of $50,000, and we add to it that decrease in income taxes payable. So, to calculate this statement of cash flows, we're going to show the cash received from customers of the $2,058. We're going to show minus the cash paid to suppliers of the $1,162,000. And that gives us our cash paid for operating expenses. Then we subtract the cash received from customers is a plus $2,058,000. The cash paid to suppliers is a minus $1,162,000. The cash paid for operating expenses up here is a plus $657,000, as we see on this slide. And the cash paid for income taxes would be a minus $59,000. So the $2 million minus those amounts will give us our net cash flows from operating activities of $180,000. Let's look at another question. Which of the following sections of the statement of cash flows will be different depending on which method is chosen to prepare it. Remember, the investing and financing activities are going to be the same. It's just going to be the operating activities that will be different. Well, there you go, guys. Here's the end of chapter 11. This is a really tough chapter. My recommendation for you is that you take that sheet that shows as current assets increase, you're going to subtract. As current assets decrease, you're going to add. And then with liabilities, as your current liabilities increase, you add it. And as current liabilities decrease, you subtract it. I think your best bet is to just have that memorized in your head so you follow it along.